Hello, how are you doing?
Very good, thanks.
All right, here we are.
Hello, everyone. We're about ready to get started here. It's 12 o'clock noon Eastern, and we're talking about LIRPs today, life insurance retirement plans. And I'm happy you were able to join me. My colleague and friend, Gaynor Milky, is going to give us a little introduction and do some housekeeping, and then we'll jump right in.
Oh, definitely. Well, thank you, Dave. I'm excited to hear this presentation because it's the first time that I've heard it all the way through on LIRPs, but welcome everybody. And just a few housekeeping items. You can drop any questions that you have into the chat. Dave said that he'll take questions as we go along. So where I see a break, I'll come in on my audio and just maybe read the question for Dave and he can answer it. And then at the end of the presentation, we will be emailing out the materials and the recording for you. So you'll have those. And you can also touch base with Dave. His contact information will be in there too. So without further ado, I will let Dave take it from here. So enjoy.
All right. Again, thank you for joining us. This is a training on life insurance retirement plans, and I'm hoping it's a lively one. I've been doing taxes and financial planning for more than 40 years. I'm a CPA, a CFP, a chartered life underwriter, PFS by the American Institute of CPAs. Back when the CFP was first introduced, one of the first to be both a CPA and a CFP, and I'm proud of that. But I really fell in love with financial planning after about 6 years in public accounting, doing everything from audits to tax work in a small firm in the DC area. And I just kind of fell in love with the idea of financial planning. So I've been doing this for a long time. I trust that everyone on this webinar, you're supposed to be a tax professional. If you're not, we're not going to kick you out. But that was my goal, was to get just tax professionals on this. And I assume that you care a lot about your clients and you always put your clients first. I have sold life insurance for 40 years, so you may think entirely the opposite end of the spectrum with me, and I welcome that. But I can assure you that in my own opinion of my own self, I am one of the most intense people about protecting clients and doing the right thing. So when I learned about insurance, I was a little bit hesitant, as you can imagine. And I have seen what's been going on for the last 10 years, 20 years, 40 years. And I think there's a gold mine here that gets a lot of negative press, a lot of naysayers, and for good reason. I'll get into that. There's reasons that life insurance does not work, and a lot of times it doesn't work, and it's a shame. But we're going to talk about how it can, so that you understand, in an ideal world, how this stuff could help and whether or not it makes sense to team up with someone who can help with life insurance retirement planning. So thank you again for being here. And let's dig in a little bit more. I established tax-free tutors basically as a doing business as for my registered investment advisory firm. Now, I'm basically retired from managing money and selling products. The only thing I do now is LIRPs, and I do it with the intent of matchmaking LIRP experts, which are few and far between, honestly, LIRP experts with tax professionals, because I understand both and I see an opportunity where, as a team, they could actually end up doing the best thing for their clients, and clients end up winning. So it becomes a win-win-win situation. I will do a LIRP. I will do a LIRP for a tax professional. I'll do it for their clients, but I'll do it with somebody in mind that I'm bringing along. And I have several of those. I have 200 or 300 people that I can tap across the country who are LIRP experts. And we can see the opportunity for tax professionals to move beyond tax preparation into tax planning and taking baby steps, if you will, with this opportunity, because I think a LIRP is a really timely opportunity for taxpayers, particularly where we are in history right now. The premise is that America's national debt is at the highest and most dangerous level ever, and it will eventually lead to higher future taxes. We don't normally deal with that premise, so I want you to reach out and think about this real hard today. Now, these higher future taxes can be avoided by proper planning techniques applied over the next 7 to 10 years. Why 7 to 10 years? Because that's where Congress is now. It's such gridlock and political opposition to each other. There's no cooperation. Every legislator is threatened by not being reelected if he wants to raise taxes or cut expenditures. So they're all just burying their head in the sand and they're not doing anything. And eventually it's going to catch up and it's going to be a worse problem because of the delays. But also there's good reasons that advisors are not telling us this, and I'm going to get into that as well. Now, a life insurance retirement plan is only one strategy that can create tax-free income in retirement. And the big one is Roth. So we're going to talk about Roths and LIRPs and where they fit in. And we'll take a close look at the costs and benefits. I'm not going to hold anything back. And I want you to not hold back as well and challenge me wherever you want to along the way. This is a tad blurry, but I took this picture just earlier today. This is the U.S. debt clock. You can reach it by going to usdebtclock.org on your computer. And it's amazing right here. It shows that the U.S. national debt is almost $37 trillion today as we speak. The gross domestic product down here is 30,000. Now, that's way out of whack. The ratio ought to be between 40 and 70% should be debt to GDP, and you can see it's over 100. In fact, it's 123%. Now, another remarkable thing down here, look at the four biggest expenses in our budget: Medicaid and Medicare, Social Security, defense spending, and interest on the debt. And you'll notice for the first time, interest on the debt is now greater than our defense spending. So it used to be it was Medicare, Social Security, defense, and then interest, but now the interest is even greater than the defense. Now, these four items make up more than 90 cents of every tax dollar that our clients and we pay. So 90 cents of every dollar is going to these four things. And if you're a congressman, what are you going to do? Are you going to raise taxes? That's not going to help your reelection. Are you going to cut Medicare or Social Security or defense? And you can't really do anything on interest on the debt without defaulting. The debt is going up like $1 million every 40 seconds. And just to give you an idea what 36 or 37 trillion means, if you think about it, 1 million seconds is 11 and a half days. 1 billion seconds is 31 and a half years. And 1 trillion seconds is 315 centuries. So you can see the magnitude of moving from 1 million to 1 billion to 1 trillion. And this is growing rapidly. We're budgeting to have a $2 trillion loss this year on the books of the federal government. And it's been going on since 2000. Basically, we have had 1 year where we haven't lost money. So as CPAs in the room, you can see that this is crazy. And we're going to have to kind of face the problem of this going into the future. Here's a chart that goes back to 1940, and it shows what the debt to GDP ratio was after World War II, rather. In 1945, it peaked at about 120%. And now, as you saw on the last slide, it's over 122%. And you can see it came down between 1945 and 1980 when Reagan was elected. And it came down because we raised tax rates during that period of time. And the target should be between 40 and 70%, so right in this range. And we brought it down to controllable, but we didn't keep it there. The next slide shows, here's the debt to GDP. The blue line is debt to GDP, and you can see the debt is going up relative to GDP ever since 1980, basically. The red line here is the interest paid divided by GDP. And we can see that that number has been going down for a while, but now it's starting to come back up. The reason is that we're refinancing old debt. Every time our debt comes due, we refinance it with new issues, we print more money. And we're doing that at higher and higher interest rates. Today, it's 4 and 5% to pay off old bonds that mature, and they're only costing us 1 or 2 or 3%. Now, when inflation becomes a concern, the Fed typically must look to raise interest rates to control it. So there's a reason that interest rates are going to go up, and it's going to be a bigger problem. And baby boomer entitlements, plus inflation, plus ongoing deficit spending, has caused our debt service to now move ahead of defense spending. And there's really no place to turn with 90 cents out of every dollar going this way. Now, let's take a closer look here. I created this little tax rate time machine. This is a married couple on both of these charts, and one is 250,000 and the other one's 2.5 million. It says 23. My 2025 is in progress right now. It's being updated, but the numbers are pretty close for 23, 24, 25. If somebody was making $250,000 in 2025, their tax rate would be marginal. They'd be at a 24% bracket, 19% effective rate. They'd pay $46,800. If we took the same dollars and discounted them back for inflation, and then we calculated the tax on those numbers and then adjusted the tax forward to today's dollars, you can see that in 1985, this couple, instead of paying $46,000, would have paid $75,000, and $80,000 here, $60,000 here, $68,000 here, $85,000 in 1945. So a couple making the equivalent of $250,000 today, instead of paying 46, would have paid $85,000 in 1945 and higher than 46 in every one of these other years. And it's in every tax bracket. If you drop this down to 25,000, you would see the same result. It's the same result, only it's worse because of the progressive tax rates. That person would be in a 37% tax bracket today, which is the highest, but that marginal tax bracket would have been 70%, 89%, even 92% back in 1945. In 45, Ronald Reagan was making movies, and he would get paid like $100,000 a movie. And if he got 2 movies made in the year, he wouldn't work anymore because the 94% tax bracket, the highest back at that time, would have kicked in at $200,000. So if he made more than that, he would have given 94 cents out of every dollar to the IRS, and he would have given 6% tax to California. So he wouldn't have made any money at all. And lo and behold, back in 1985, he came out with the tax code of 1986, which it is still today, as amended. And he was part of the reason that we reversed our taxes and have been low ever since, but we're running into the same problem again. Former U.S. Comptroller General David M. Walker, you may have heard him speak. He's all over the country. He says that all tax brackets must nearly double. If you just tax the earnings on those making more than $400,000, that number's been thrown about a lot by Biden and others, your effective tax rate on every dime of that income would have to be 104%. So it's not going to just be the wealthy. It's going to have to resort back to where these tax rates were double the 34% effective rate here. Now, where does LIRP fit into all of this? Life Insurance Retirement Plan is a futuristic tax plan that looks at taxes way down the road. Same way that you would consider a Roth to be beneficial down the road. A LIRP is often called a super Roth IRA, and we'll go into why. But it's designed to have another tax-free income source that will complement Roths and health savings accounts. So the first thing people want to do is Roths. They're going to be easy. They don't involve any hidden fees and stuff like that. You can do IRAs, you can do IRA conversions, you can do 401ks, 403bs. A lot of people can do more Roth accounts today than they think they can, even if their income is high. We need to kind of educate them on what more they can do in Roths. Health savings accounts, we all know those are like a triple tax break. So those should be on the table. I like to use LIRPs when there's dependable excess cash flow or excess assets that can be repositioned. So if somebody's pretty much maxing out their Roth options, then they still have more money. Maybe they even inherited $1 million and they're just getting 1099s on how that's invested. You want to look for assets and income that are a little excess. So these are going to be your affluent clients, the people in the 24%, 32% brackets. They could be ideal if they have the right cash flow. Let's take a look at how a Roth stacks up to a LIRP. Let me know if I'm going too fast and there's any questions, but I just said, what if we have $50,000 a year available to put into a LIRP? Now, life insurance retirement plans are designed to be overfunded and funded heavily. So it's not for people that want to do $500 a month, although I've got some youngsters doing that. Some people in their 20s and 30s are starting off with that and hoping to add more later. But $50,000 available. That could be a $75,000 Roth conversion. You pay $25,000 in taxes and you have 50 left. It could also be the same 75,000 conversion money you're going to put into the LIRP instead. This could also be excess assets that are in taxable accounts and you'd like to move them into something tax-free and they're too big to move into a Roth otherwise. So here I had the computer run these things at a 6% average rate of return for each, just to show comparable values. Now, you may expect more from one or the other. We could get into those reasons later. But if they did the same rate of return, how would they stack up? So we have a 55-year-old putting in $50,000 after whatever taxes, after tax dollars going in to the LIRP on this side and the Roth on this side. The computer told me, the program told me that with all the charges in the LIRP, you could probably pull out $47,850 a year for 15 years. And then the policy would hold its own until age 100 or beyond. So I tried to take the same $47,000 out of the Roth conversion at a 6% return, and it gave me 18, 19 years to deplete the count down to zero. So after 30 years of doing this, 10 years paying in, 20 years coming out, the Roth is depleted. The cash value of the life insurance is $259,000 and the death benefit is $353,000. So if this person died at age 84, the family would get $353,000 tax-free on top of the money that was taken out. Looking at the next 30 years or 20 years or whatever, on the next page, year 31 and beyond, you're getting nothing out of the Roth. It's depleted and you're still taking nearly $50,000 a year out for another 5 years. And you still got $170,000 in cash value, $300,000 death benefit, and that actually starts going back up. So at the end of this comparison, you're able to take $1.2 million out of the life insurance plan tax-free versus $920,000 tax-free out of the Roth conversion, and there's still a death benefit there of anywhere from $300,000 to $800,000. The management fees anticipated on this Roth were 1.5% per year. And if we ran this at 0% per year, the money would have lasted all the way through here, but they would have had much less left in the Roth conversion versus the money in the LIRP. It's basically because the life insurance policy is front-loaded and it's very inexpensive in the last years, and it's less expensive even in the middle years. So a life insurance policy should be expected to cost a 1.5% per year, but it's going to be front-loaded. It's going to be higher in the early years and lower in the later years. And does that sound like a mortgage to anyone? A mortgage is a way to own expensive real estate and to pay it off over time, but your expenses are going to be biggest in the early years and lowest in the later years where you're really building up the equity. Same kind of thing happens with life insurance. And the reason it has to happen that way is that life insurance is a big expense right out of the gate. Life insurance companies will promise $1 million death benefit and they'll charge you $1,000 premium. Well, how are they going to do that if you die soon? They have to build up reserves to fund that long-term thing. They have to have a lot of lives in their risk pool. They have to have a lot more people living than dying. So they have to get started early on building up the cash. And that means that the expenses have to be higher in the early years. But because it comes with a wrapper of access to the cash tax-free, eventually you build up enough money that your tax savings by not having any of that tax is going to exceed all the charges in the policy. But that takes a while to get there. So the bad rap that life insurance gets is usually because of the fees and the commissions and all of that stuff. And it's legitimate, it's true, but it's also an economic reality. Insurance companies will pay big commissions to agents to sell these permanent policies, right? They don't want to give away their money. They're paying that to their agents to get more numbers on the books. They have to have large risk pools. They have to have a lot of people paying those nickels and dimes in the early years in order to cover their expenses. So if you think about it from an economic standpoint, there's some justification for it. And then when you compare it to other expenses, they're going to start off slower, but they're going to catch up. If we go back to this example, after 10 years, $500,000 has grown to 638 in the Roth, and it's 557,000 of cash value in the LIRP. So it looks like you're winning over here, but there's a reason why this is starting off at a slower pace. Look at it in year 20. This 372,000 compares to 403,000 left in the LIRP. So these middle years is where it's really going to pay off. And these are the years that our clients are going to be looking at 50% tax brackets or 60% or 90% or anything higher than 24 and 37 and so forth. So if it's true that we're going to see higher tax rates in the future, then you really ought to be thinking about how this is going to look in 10 or 15 years. And you're going to be a hero for bringing it up right now in 2025. Makes sense? I hope it does.
Well, Dave, we do have a question here.
What's the question?
So we have, how does the LIRP continue generating income after death? Is there a reason why you stopped at age 100, or is it just an example?
Great question. It doesn't continue paying income after death. I was just saying that if they died at a certain period, this is what would happen. But when they die, this is the death benefit that gets paid off. So basically, you put in $500,000 and you've taken back 1.2, and let's say you die right here at age 90. Your family has already you've already spent 1.2 million, and the family would get a check for $331,000, and that would be income tax free. Who knows if it would be taxable in the estate? Those rules seem to change way too often, but it would be income tax free. And all of the money that you took out was tax free, and it was borrowed, and it was held in the policy as collateral. They're loaning you the insurance company's money. You're not really taking your own money out. So your own money can still be earning interest, and that usually is equal to the amount that they're charging you, but not with every policy, just with the right ones. And so what happens is you never pay the interest, you never pay the loan off. It reduces the death benefit. And then this death benefit is the net check that your family receives, all income tax free, and all loans are forgiven.
Okay. And then we have another one from Denise, which says, your example has the age beginning at 55 years old. Is there a best age to start a LIRP?
No, very good question. I like age 50, 55, 60 even, because this is usually when people have their biggest obligations behind them. They've accumulated a good fat, tax deferred IRA or 401k. They've accumulated some investments. The kids are through college. So it's an ideal thing, a pre-retirement, even retirement years. It can work very well. You can do it at any age though. I mean, I've got people that would inherit $1 million and they want to move 300,000 of that into a LIRP. We can do that. Let's do 30,000 a year for 10 years and we'll get 30% of that $1 million moved over. So I'm looking for liquid dollars and consistency. They might want to do something like this, but when things slow down and they don't have that $300,000 income, they could be in trouble. If you stop the funding on this thing, which is one of the reasons they fail, then you end up paying for more death benefit than you needed. When you design one of these things, the budget is really how much money can you consistently put in for 5 years, 7 years, 10 years, 20 years. So we get a target of how much we want to put in, just like you would on a 401k or a defined benefit plan or something like that. You would say, yeah, I can allocate $25,000 or I can allocate $100,000 because I've got $2 million in a taxable account over here. So I will work with a client and say, what's a budget that we can do over the next 7 to 10 years? And let's buy the smallest death benefit that we can. So you can see the initial death benefit is an odd number because that's the smallest death benefit the IRS will allow for a $50,000 premium on a 55-year-old. So if they were 35, it would be a different face amount. And if they're 65, it would be a different face amount. So when you have $1 million death benefit and 500,000 in cash value, the insurance company is only charging you for the difference, right? Because you've got cash value there. They're going to pay $1 million, but 500 of it's your own. So you're only being charged for the insurance costs of $500,000, whereas it was 871,000 in the beginning. So you want to squeeze it, put it through a vice and get all the expenses down as much as you can. But you really want to set the target based on how much you can contribute consistently and with the goal of moving this into tax-free buckets for the rest of your life. Great questions. Moving on, it's a complement to Roths. We're repositioning assets subject to current and future taxes. So I'd love to go in and say the people in the sweet spot, your clients that are in the 22 and 24% tax brackets, they should be using those entire brackets.
Oh,
They
Dave,
yes.
we actually have a question that kind of ties into what you just said, your clients in the sweet spot. Some professionals say that about 80% of whole life policies are surrendered. What type of clients would benefit most from LIRPs, given that it might not be the best option for lower income individuals?
Okay, great question. It's really term insurance that they're probably quoting. It's not 80% of permanent policies collapse. It may be pretty high, but I know Penn State did a study that's quoted often where 93% of term policies will lapse without paying a death claim. And that seems outrageous. It seems like a ripoff, but it's really just the numbers game. You know, they take in those premiums, they promise a big death benefit, and they know that more people are going to live than die, and they can do that. If it's a permanent policy, they have to charge more than they charge on the term policy because they have to build up some cash reserves. Those policies are going to last a lot longer. Most of them will pay a death benefit. So I'm thinking more like 80% of them do pay a death claim rather than don't. And they have to fund those differently. It's a different numbers game. And term policies are meant for people that have children and mortgages and things like that. And they build their own assets up and they don't need that life insurance anymore. And that's about when it's going to get too expensive. You could pay $1,000 a year for $1 million policy. And then in year 21, you know, the premium jumps to $12,000 instead of $1,000. They design the products that way that they're covering the years where you're most vulnerable to losing your income, and then you don't need it later on. Yeah, let me address that. This LIRP is for people that have extra money that they want to convert to taking it out during their lifetime. So permanent insurance versus term is one thing to think about. And permanent insurance might be justified for people that would otherwise buy term if they have long-term needs, if they have a business that they want to pass on to one family member and they want to have some cash to pass on to the other family members. There's a buy-sell needs, lots of reasons for permanent insurance that's not going to be overfunded. The LIRP is life insurance, retirement plan. So the RP part of this means that we want to super fund this thing and get the money to compound over time and come back out tax-free. And we want it to work like a Roth. So it's really for the candidates that have the cash. So I wouldn't put a LIRP in place for somebody that doesn't have a lot of excess cash or excess income. So it's really for your best clients. But your clients are hearing their other advisors, like your investment advisors, don't ever put money into a life insurance policy. Well, the first thing that person wants to do is have more assets under management. Probably 98% of money managers do not sell life insurance, and they don't want you to move assets into a life insurance policy that they can't manage. So they'll tell you these expenses are outrageous. I can get you 8 or 10 or 20. They're going to be motivated to not allow you to move the money. That's one person that ought to be advising you on the LIRP concept. Second person is the tax advisor, tax planner. And you in the room know that You don't like to predict the future. You want the tax bill to be as low as possible. So you may not even talk about conversions at the 24% bracket, which might be smart because you don't want the client to have a bigger bill. So I'm trying to get people to think outside that box, think long-term, become more planners, think about futuristic tax planning or lifetime tax minimization. If you can load up Roths and you can load up a LIRP, down the road when they change the rules, you can have a couple $100,000 coming in that doesn't go on the tax return. And by diversifying, which is, adding a LIRP to a Roth, then you've spread your risk a little bit if they have to change the rules. So if they have to change the rules down the road, and they will, they're going to have to raise rates. They're going to have to change the taxation on things. They're going to see trillions of dollars over here in Roth accounts. They're going to see a few $100 million of life insurance cash values. They're going to say, okay, well, let's not mess with the life insurance. That's actually a contract between insurance company and the insured. And we don't want people canceling life insurance and their family goes on welfare later. They've always grandfathered tax law changes when it came to life insurance. There's no guarantee they will in the future, but you've got trillions of dollars in Roth accounts. Why don't they go back and do what they did with Social Security, which originally started out totally tax-free? Now you can pay tax on up to 85% of it. So they may say, okay, your Roth accounts, we meant well, but we can't do it anymore. So we're going to tax 10% of whatever you pull out of a Roth. And by diversifying your strategies, you're diversifying your tax risk. Makes sense? Also, these life insurance policies nowadays will put in long-term care benefits so that if you're in your 80s and you need long-term care and you got a $500,000 death benefit there, you could take up to 25% of that money out every year and use it for long-term care. It's actually a prepayment of a death claim that they're already ready to pay. So they're going to prepay some of your death claim and let you use it for long-term care while you're alive. You can't get that out of a Roth. So I like to structure that as a fallback. If you don't use the long-term care benefit, you don't pay for it. How you pay for it is if you want $100,000 of that $500,000 benefit, they're going to say, okay, you want that at age 80. We expected you to die at age 87. So we're going to give you 90,000 instead of 100,000. But we're going to reduce the death claim by 100,000 and give you 90. So that's how you pay for it. And you have the option of doing that or tapping other assets. So that's a nice feature at end of life. Income and respected decedents on taxable accounts that pass to heirs. It could be balancing the wealth to your heirs. You can be paying any other kind of taxes that might be due, step up taxes, capital gains taxes if they still have those and you don't get the step up at death. So there's all kinds of neat things available at the end of life as well. And again, with life insurance, there's no income required. There's no income thresholds. There's no contribution limits. If you want to put in 100K, there's no worry to do that. Age requirements, there's no early withdrawal penalties, no 59 and a half, no 72 rules. So you got a whole lot of options in here as well. And again, most appropriate when a taxpayer has the excess cash flow or liquid assets, large balances in non-qualified accounts that generate the 1099s every year. LIRP advantages are decades into the future. Now, it takes a good tax planner to be thinking with their clients about what it's going to look like 10 years from now, 15 years from now. I took you back to 1945 to 1985, and you can see how ugly it was. If you're anticipating that possibility and you're realizing 10,000 baby boomers a day are signing up for Social Security and Medicare, that the interest that we're paying on the debt just exceeded $1 trillion a year, it's crazy. And there's really no way to turn other than raising rates. So if you're anticipating that with your clients, they're going to be happy as heck that you introduce them to somebody that's not going to rip them off. And if you work with a LIRP expert, and I can introduce you to LIRP experts that are going to do this properly, then it's a win-win-win situation, and your clients aren't out there searching for something that's going to fall apart later. So that's why I'm so passionate about it. I really think it's doing the right thing, and I think there's proper ways to do it, and there's wrong ways to do it. And because those commissions are so big, in the first year of a life insurance sale, that agent, whether they put in a LIRP or not, they're on to the next sale because they get a 50% commission the first year. They get a 1 or 2% commission on subsequent premiums. They could care less if the policy falls apart, and it will, because you'll have people talking about what a stupid mistake you made. So I like having a tax planner involved who's seeing their tax picture every year, who can keep them focused on the realities, who can talk to them about tweaking their contributions so that they're the most tax efficient way of funding them and so forth. Let's move along so we have plenty of room for some questions and answers. I will be able to go past 1 o'clock, or I welcome anybody to stay if they want to. This is being recorded. You'll have access to it. A lot of people registered and they're not here, so I'm doing this for them as well as you. And I want you to think about this and reach out to me, and let's just have a conversation and see if you're a candidate to add this concept for the benefit of your clients. So a taxpayer purchases a life insurance policy designed to maximize the growth. So it's the smallest policy they can buy with the amount of premium expected to go in. You put the contributions in. They can be flexible. I'm talking about an index universal life policy here. You can also use variable life policies. You can use whole life policies. Each of them comes with their own different bells and whistles. I like the flexibility of an indexed UL, and I like the growth potential of the indexes. Mostly, I like the fact that they don't lose money. With a variable policy, you could get a 50% return on the stock market. You could also lose 30% if the stock market goes down. With whole life, you're going to get dividends. You're not going to have flexible premiums. They're going to do well, but it's pretty much fixed from the start, and there's not much flexibility. So the IUL I found works well, especially with business owners when things can change, but you want to get it back on track, but you need a year to do it differently or something. Cash values, net of all the fees, grow over time, and they can be withdrawn or borrowed. So once you have a profit in there, you can access it either through withdrawals or loans. And the better policies, here's what happens with a loan. Most policies, they'll loan you money. They'll take it out of the cash value and put it into a collateral account. They'll still pay you interest on that collateral. They'll still credit you something, and they'll charge you interest on the loan that you took. Most companies will actually charge you a little bit more than they'll credit you so that they make more money. But that's also going to be against your strategy a little bit. It's going to drain you over time, even if it's a 0.5% or 1% difference. I use contracts that are guaranteed wash loans. So if they take $100,000, they put it into this account and they credit you 4%. That's exactly what they're charging you, 4%. So that loan is not going to grow. It's going to be wiped out from the death benefit. There's also policies that will allow you to keep it in the index. So if the index, S&P 500 or any number of other indexes, if it earns 8% and they charge you 4%, you've made a profit. Of course, you take the risk that it's going to earn nothing and the index goes negative or something, you'd get a zero return and they still charge you 4%, but that doesn't happen as often as the reverse. So there could be a positive spread over time if you wanted to be a little bit more aggressive. A lot of older people might be just fine with the wash loan. But that's a way to access your money. There's no tax. There's no real interest cost. It's just basically a prepayment of your death, and it comes out of cash that you've accumulated without any tax drain on it along the way. If it earns 6%, that's $30,000. It doesn't go in your tax return. So that $30,000 that doesn't go in your tax return would have cost you at least $10,000 in taxes. But if you look at that year, you're probably paying $2,000 or $3,000 in fees instead of $10,000 in taxes. So if it's funded properly and you stick to the plan, it can really sizzle over time, especially if tax rates are going to be higher. Again, I talked about this already. The two advisors that should be talking about this are the tax professional and the investment advisor. So nobody's talking about this. I was going to put together a few slides on reasons that some LIRPs fail. And I've done this on LinkedIn, did a whole series of most LIRPs will fail, and that's why I sell them.
Okay. We have one other question here.
Okay, shoot.
Is there any instance in which overfunding a LIRP can trigger the IRS to reclassify it as a MEC with no tax advantages. I've heard some talk around the 7-pay test, but I'm not sure if it applies to this product as well.
It does, absolutely. MEC means modified endowment contract, just some weird term that the tax code uses. It basically says if it's a modified endowment contract, then it's going to be taxable when you take the money out and you have gains. So yes, it could become a MEC. They won't issue a policy unless you sign another form that says you understand this is a MEC. And I've used MECs in the past just to get an immediate higher death benefit. I overfunded it with a lump sum, and somebody's going to get 2 or 3 times that when they pass. But you don't want it to be a MEC because then it loses the tax-free wrapper that it comes with. But they tell you in the beginning that if you're designing this thing, then you got $50,000, then you need a death benefit of $871 for a 55-year-old. So you design it in the beginning. If you accidentally send them in more money than the $50,000, you send it in a week before the premium was due, they're going to tell you, we can't accept this unless you sign a form saying that you understand it's going to become a LIRP. So it's happened to me a number of times because people will be sending the money in too soon, but it won't become a MEC in 99.9% of the cases because the insurance companies will not let you do that unless you intend to. Great question. And you want to tweak this thing against the MEC limit. So if somebody's putting in $50,000, and this has happened as well, I've had clients come to me and say, 50,000 was great 5 years ago, but I could do 100 now. I could do 75. We can't put it into that policy because we tweaked it from the beginning. But we could ask for an increase, and if you're healthy enough, you'll get the increase approved, and now you can put in another 25 grand on top of that every year. But you take that risk if you design it in the beginning to be maxed out. So that's another design feature. I talk that through with every single client. It's like, okay, what's realistic today? What's realistic in 5 years? What's realistic in 10 years? And do we want to add a little buffer so that you do 50,000 for a few years and then you can do 60 or 70 if you want? If you're short in any year, you can make it up in another year. So if you did 50,000 for 2 years, skipped a year, in year 4, you could put in 100,000. So great questions. I love it. The economics of the insurance industry makes them an easy target to bash. But insurance companies have to charge a lot in the beginning to get this thing legally funded. They have reserve requirements with insurance commissioners that make them legal insurance companies. They have to reach those funding reserves in a certain period of time. So they have to charge more. Unfortunately, they also have to sell a lot of it, which means they have to incentivize insurance agents to go out and sell a ton of this thing, and they pay them up front. If they leveled out those commissions, the guys would make as much money, but they wouldn't be motivated to sell more as much as they are now. So there's a lot of reasons why they will fail, and all of those are controllable, in my opinion, if you put the two together. If you work with a LIRP expert and a tax planner, your clients are going to win big time, and they're going to be diversified from a legislative standpoint, from a risk standpoint. With the cash value in a LIRP, if it's protected from losses, then in a year when the market goes down 30%, their Roth account's probably going to take a hit, but the LIRP account's not. It's going to get a 0 return. Now, the year after that happens, do you want to pull that 50 grand out of your Roth IRA, or would you rather let it sit for a while and recover? That's when you can tap a little bit more out of the LIRP because it didn't take that big hit. You take more money out of the LIRP and let the Roth recover. Another key to making this successful is don't compare this to a stock investment. If you're in a LIRP, whether it's a whole life policy or an IUL, you should expect like 4 to 7% returns. So you should use your bond assets in a diversified portfolio, 60-40, tap the 40% that's in bonds and move it to the LIRP. You're going to get downside protections because bonds can lose money as interest rates go up, and that's more likely than the reverse now. And you're going to get returns that can mimic the stock market up to some caps and so forth. So you can have a 10, 15% return on your LIRP in any given year if the market does really well. And that's going to average out to something that's probably better than bonds. I like to use bonds to fund the LIRPs, and I say you're going to get 4 to 7%, even with negative years. You're going to get zeros, but the other years you're going to get 8, 9, 10% returns. I see it happening all the time because they're tied to indexes that can do that. So I wrote an entire book on this. It's about 100 pages, and it's in the final reviews right now. So that's going to be coming out. I would encourage everybody to look for that. It's the Tax Pro's guide to this thing, and I go through all of these in depth. But a LIRP, if it's structured properly and you stick to the plan, it can be super powerful. We have time for questions now, and I have a few that I can go through, but I'd much rather hear from the audience. Anybody want to make a comment or questions? Gaynor, can we turn on the microphones if we need to?
Of course. Yep.
You know, I think I blew by a slide here on David Walker.
As far as somebody's interested in this, what have you seen other tax professionals do to like start working with LIRPs?
I've worked with a number of tax professionals in the past. I've added $100,000 a year to their incomes by putting these in and other investment ideas in and so forth. You can bring on an expert that you trust, and it could be somebody you're already working with. I can vet them. I can make sure they understand it as well as I do, and then they can take care of your clients. But we can also do it with somebody new. I can get this thing started. You can just make sure that your clients are taken care of, or you can get licensed for life insurance, for investments. And there's a trend out there. A lot of CPAs are doing that. They get their licenses. They make the expert do 90% of the work. They bring the clients in, they represent the clients, ask the right questions, but they get paid on the commissions just like the LIRP expert does. And clients are actually happy with that. And I've had a lot of success with that. They trust you, and they're not going to stop trusting you just because you're being paid out of the products. As long as you're doing the right thing and the team is doing the right thing for the client, you'll see that they're very happy with that. Let me do a quick video. It's David McKnight is a best-selling author on LIRPs, and he's talking to David M. Walker, former U.S. Comptroller General.
Well, there are two real fiscal sustainability metrics you need to look at. The first one is debt as a percentage of the economy. And we have passed the all-time record of debt to GDP, which was achieved right after World War II. But unlike the end of World War II, where we brought down debt to GDP dramatically between 1945 and 1980, we're now adding debt to GDP at a rapid rate and are expected to continue to add to it even after we defeat COVID-19. The second metric you have to look at is interest as a percentage of the budget. Because what do you get for interest? The answer is nothing, absolutely nothing. Right now, we're in an unusual situation because we're adding debt at record rates, but because interest rates are so low, our interest expense is not increasing. But that's temporary. And why is that happening? Because we don't have regular market conditions right now. The Federal Reserve is self-dealing in U.S. debt. It is buying a significant percentage of all U.S. debt issues. It is artificially holding down interest rates in order to try to help with the economy and unemployment. That will not be sustained. The other reason that we have a problem is because you've got some liberal economists who've come up with this new modern monetary theory that basically says that deficits and debt don't matter as long as you can borrow in your own reserve currency unless and until you have excess inflation. Well, we don't have excess inflation now, but if we follow that theory, we will have excess inflation. And the only question is when and how much, because that theory is contrary to history. It's contrary to the long-established macroeconomic principles. It's based upon a flawed comparison of the United States to Japan. Politicians are already fiscally irresponsible. The last thing you want to do is give them an excuse to be even more fiscally irresponsible. But you cannot solve our problem solely by taxing the rich. The numbers don't come close to working. Tax rates will never be lower than they are now. And contrary to what many people have told us for many years, that, oh, gee, you want to defer as much income as you can, because you're probably going to end up paying a lower tax rate when you're retired than you are when you're working. That no longer is a credible assumption.
Okay. Any other questions? Here's one that I get a lot of times. Won't I miss out on the growth if I convert now? So if you convert $100,000 to Roth, you're going to pay taxes today. So if you paid the 24% out of the conversion, you'd have 76,000 left over. But let's say over the next 10 years, 20 years, your money's going to double whether you convert or you don't convert. So if you take the taxes out of that 100,000, you got 76,000 left. It doubles to 152. If you don't convert, that 100,000 doubles to 200,000. And then if tax rates double, you pay 48% taxes instead of 24, then you're going to have 104,000 left over. And in this last column, I just take the tax rate up by 1 percentage point from 24 to 25. And even in that case, $200,000 leaves you 150 versus 152 if you convert it now. It's the tax rates. And if you're more likely to pay more taxes later, it makes sense to convert now. And here are 4 tripwires that'll push you into higher than expected tax brackets in the future. So even if a client doesn't really believe they're going to be in a 37% or higher tax rate down the road, well, here's some things that might come into play that could trigger higher taxes. Regular IRA distributions, even RMDs, may be larger than needed. Anybody have clients that have RMDs that they don't really even want and they have to pay taxes on them and they're just taking the minimums? Well, that problem just gets worse and worse because the minimum is probably less than it's earning. Medicare premiums, as we know, go higher due to your income levels. If married and one spouse dies, your new tax rates are nearly double from there on. Untaxed IRA balances might pass to your heirs in their prime earning years. How many clients have a couple $1 million in a tax-deferred IRA? They could convert now at 24%, or they could leave to their kids at a 48% tax bracket later on. So there's all kinds of reasons why this does make sense if you're thinking outside the box, if you're thinking long term. Why aren't more people doing this? There are actually tens of thousands of people doing this. The great majority of insurance is sold purely on commissions and so forth. These things can fall apart if they're not tended to, and there's going to be naysayers out there. If you're protecting your clients, they're going to be damn happy about it in 10 years when the tax rates are higher. And they've got both Roth and LIRP money, and they've got large death benefits, and they've got long-term care protection. They've always grandfathered stuff that's on the books. They don't want to run on the insurance company's assets. They don't want the effects that the stock market might have when the insurance companies are in trouble. They don't want people dying without insurance. There's a lot more money to tap in Roth. Even if they don't tap all of it, they can tap some of it, and it would still be lower hanging fruit as far as Congress is concerned.
I think some people couldn't see the video, so I just wanted to say that we'll add the link to it to our follow-up.
Yeah, thank you so much for your time. It's 1 o'clock. I really appreciate it. I hope you've learned something valuable, and I hope you'll reach out. Let's just have a conversation and see what your practice is like, what we might do to help your clients. And here's some resources. You'll see this when you get the slides as well. My calendar, my email address, and a number of resources on taxfreetutors.com. So I welcome you to go there. If anybody wants to stay, well, you're welcome to stay and we can chat. Otherwise, look forward to hearing from you. And thank you so much for your time.